Hey everybody, Jeff Yastine here, and I'm talking to Mike Carr, and we're just going to talk something about volatility. You know, we all know, Mike, that the overall volatility of the stock market for months, maybe years now, it seems like the level of volatility, the up and down daily movement, seems to get overall less and less. Number one, is that true? If it is, why?
It's definitely true, Jeff. We are seeing volatility decline, and it's fallen off a cliff this year, so to speak. And part of it is a structural shift in the markets. We're seeing an awful lot of index funds out there, and those index funds aren't buying or selling. They're simply buying. They're holding stock, and that's reduced the volatility. We don't have as much trading in a lot of securities. In addition, high-frequency trading, I know it may not sound logical at first.
These are the guys who are using computers and they're just, boom, going in and out of the market 100 times in a second or 1,000 times in a second, right?
They're trading in less than the time it takes us to blink our eye. They're buying and selling in that time frame, which sounds like it should increase volatility, but it doesn't, because what they're doing is providing liquidity. They're trading, they're trying to make maybe 1/10 of a share, 1/10 of a cent per share. Small amounts of money, do it millions of times a day, it adds up to real money. But because they're trying to do it in such small increments, they've reduced the volatility of the overall market.
So it sounds like you're saying that, you know, there's this huge force, passive investing, people putting their money into these index-based exchange-traded funds, but there's really nothing to counteract on the other side. So we're just getting this continual push down in volatility, and meanwhile stocks and the broader indexes just keep marching ever so slightly higher.
Right, because there's not as much selling from those index funds, there's going to be a stronger upward drift in the market until it turns down.
All right, well,
and that's when you're going to see all heck break loose, so to speak.
The crystal ball question, when does it turn down? Because it's easy to think, oh my gosh, this is never going to end. We're just in some sort of perpetual system where things continually move higher, however slow, and we never get that reversion to the mean. Will it change?
Exactly, and it will change. We're over a year now without a 5% pullback. That's going to be our tell. Markets are going to pull back 5% at some point. When they do, we want to watch how fast it occurs. If it occurs in less than a month and breaks through that 6% pullback, it's off to the races, to the downside.
Really?
Because that means the buyers are relatively weak and they're going to be shaken out. They're very nervous. So if we see a rapid acceleration to the downside, that's your signal to get out.
What if it is more of a gradual sort of decline where a series of months go by and the market just sort of drifts lower, but there's nothing to get particularly excited about if you were a bear?
So basically flip what we're seeing right now, where markets are low volatility grinding to the upside. What if we get low volatility grinding to the downside? And although we're seeing that low volatility at the macro level in the VIX, so to speak, the VIX index is measuring the volatility in the S&P 500. There's actually a lot of volatility under the surface. If we look at a dispersion of returns, we're seeing a lot of variability. So a lot of big winners, a lot of big losers. That's what we're going to continue to see.
Well, Mike, thank you for chatting with us.
Thank you.
And we've been chatting with Michael Carr here at the Diplomat Hotel in Hollywood, Florida.